Hello everyone, welcome back to Financial News. I'm Ron Jankowski with Channel 4, and of course we have Paul Munichel from Ameriprise Financial. I want to mention that because of all of the focus today, and rightly so, on the coronavirus, our show is going to be kind of directed to that, and Paul's got a lot of information to share with us. So we're going to go through getting you up to speed as to what took place in the marketplace last week, and then we will go on from there, and Paul's going to share that with us. So, Paul, I'm just going to let you take it from there.
Thanks, Ron. I'm sure everyone watching this is very aware of what is going on with the coronavirus, both here in the United States and overseas. And the market was definitely reactionary to it last week. And as Ron mentioned, we are going to try and update you as to what took place last week and where that really stands in historical pullbacks and what it could mean for the market moving forward. So number one, we're going to start with re-examining the outlook for the markets. Some forecasters have very recently, they've issued new guidance as to economic growth expectations for the S&P 500 earnings per share, their estimates for the current year. We, meaning Ameriprise, will publish new communications relative to our economic forecast shortly, but we still strongly believe the U.S. economy will see a solidly positive growth print for the current year. Our real GDP forecast for 2020 has been positive 2.1% versus 2.3% positive in 2019. And our initial modeling for this very fluid situation suggests a modest reduction as being the most likely outcome as a result of the coronavirus situation. At any given time, forecasters are simply trying to predict the most likely path. In this case, we still believe the most likely path is that the situation will be temporary, maybe a few months in duration, just as past viral outbreaks have been in modern history. Meanwhile, we believe the key to the potential intermediate-term path is that underlying economic fundamentals entered this situation on solid footing. Nearly every economic downturn in the modern era has been fueled by too much consumer debt. That is certainly not the case presently in our view, a condition which should support the economy's ability to rebound as the situation eases. Another necessity in this and all market corrections is managing fear. Unfortunately for all of us, fear sells. As such, moments as this bring out in droves those seeking to leverage this natural human emotion for their own benefit. The comments shown below are pulled directly from our consumer debt report. It's called Fear Sells. Aside from the strict economic implications of consumer debt, we also felt a need to produce this report to counter some of the perceptions created by the New York Fed's recent release. Unfortunately, fear sells. As such, even headlines from reputable news sources can sometimes be tinged with a note of danger. Beyond that, supported by actual underlying circumstances. Our natural human instinct to be on watch for potential threats has served us well for millennia. But in today's world, financial threats have replaced lions, tigers, and bears in the hierarchy of our vulnerables. As such, we don't see too many news headlines that read, "Things look okay." No one buys that newspaper, or in today's terms, clicks on that story. However, at the end of the day, being overly cautious can be as detrimental to achieving your financial objectives as taking on too much risk.
Okay, and the Ameriprise Financial has supplied us with the morning notes, and the morning notes are actually as of March 2nd, 2020. And I want Paul to jump in after I share some of the information that they shared with us, if there is anything you want to add to this. And the first one is domestic stocks are now indicating losses at the open after futures had rallied as much as 2.4% in early trading.
Well, that's interesting, right? Because as we sat in your office before filming today, and it is Monday morning, but the markets are clearly open, the markets were rallying to a very high level. So the situation is that fluid and reacting that quick. And in fact, just the time from me parking my car in the lot to getting into your office, I think the market had jumped a couple hundred points.
It's amazing what is taking place today. The other note is the 10-year Treasury yield reached another record low this morning, and with the yield falling below 1.04%.
It's low rates due to people panic selling and going to a safe haven Treasury bond. That's good for people with mortgages and looking to refinance or purchase a new home.
Yep.
But it is a number to be aware of.
And refinancing probably is going to be a very active
It already has
program.
been.
Yeah, it has. The other note is stocks in Asia traded mostly higher overnight, with the Shanghai and the Shenzhen exchanges each gaining more than 3% during the Monday session.
So they're ahead of us. If they're up 3% today, potentially we might be able to do a similar number.
Yep. And the price of West Texas Intermediate crude is higher by 1.3% as the commodity rebounds off of a 14-month low.
Like a lot of things, crude sold off in this panic last week.
Yeah, it sure did. It did help our gas prices, though. It at least maintain them. Sometimes it did creep up a little, but world capital markets, we're going to talk about that. S&P 500 is a minus 8% year-to-date. Dow Jones, a minus 10% year-to-date. And the NASDAQ Composite, a minus 4% year-to-date. And that is all happened in this last week.
Those are big numbers. To our regular viewers, last week we reported all positive numbers. That all happened, just like you said, Ron, as a result of last week's market activity. It was very violent to the downside.
Paul, I'm going to let you go ahead and give us a narrative that you have put together about the coronavirus and more information about that.
Thank you. I do have some closing thoughts on coronavirus to leave you at home, and hopefully it may alleviate a little bit of your fears. There's just so much unknown yet, so we don't know what to make of this. But I'm going to give you some facts that we have, and maybe
it changes by day.
It changes
by
quickly.
the hour almost.
And it's just so much. How many cases are in the United States? How quick is it going to spread? How deadly is it? That's the scariest point to all this. And you just really don't know. So in an unknown situation, that's when fear can settle in pretty easily. So I'm going to give you some facts, and hopefully that'll help the viewers at home in some way. So here we go. Some thoughts. The three U.S. major indices are now in correction territory. Ron just gave us the updated numbers. And that's defined as a decline from their recent highs of 10% or more, but not yet a 20% decline, which is properly defined as a bear market. As of yesterday, and this meaning Friday, the S&P 500 was down 12%. That was lower from its February 19th all-time high and 7.8% lower year-to-date. This is an unusual situation. The primary driver of the current decline is much different than normal economic factors that have propelled stock market prices to the downside in the past. Of course, it is not the virus itself that is hurting economic or corporate prospects, but the actions being taken to prevent further spread. Such actions are rational and necessary. They have and will hurt economic activity in the near term. But consider that although production rates are still well below norms in China, they are generally above 50% and beginning to rise. The unusual nature of the situation also presents positives and negatives for investors to consider. A clear negative is that there are greater unknowns. Even virus experts do not know for sure how things will play out. However, a positive is the economic foundation was solid coming into the current period. That's in our view. A perspective that bodes well for recovery prospects on the other side. To put it in human terms, a person with a serious chronic health issue that catches the flu and recovers, we still struggle with the chronic condition that they will get from the flu. A healthy individual will return to good health, in most cases, bearing anything else to consider. So a few thoughts. Friday morning, CNBC noted there have been 26 market corrections since World War II, with an average decline of 13.7% and an average recovery time of about 4 months. And that's based on a review by Goldman Sachs. In addition to these periods, there have been 12 bear markets with an average decline of 32.5% and a recovery time of 24 months. In any of these instances, as painful as they would have been at the time, would it have been wise for the long-term investor to get out of the market? The answer to that is probably not. Even after these past few days, the S&P 500 is substantially higher than levels seen in those past episodes. The situation is clearly not over, but it is very likely to prove temporary. No one can predict the future, but we believe the odds of it being temporary are simply supported by the fact that every viral outbreak in modern medical history has proven temporary, generally speaking. Treatments and vaccines are also feverishly being produced and developed. Again, we've been through this before with general success on both fronts. Finally, in the meantime, put the odds in your favor. Many companies, industries, and sectors that are unlikely to see any material negative impact from the situation have been caught in the downdraft of the financial markets. Such segments may be close to their lows, offering potential buying opportunities. However, we believe it remains wise to avoid exposure to securities that still face ongoing risk, as the situation will probably continue to worsen. Those with high fixed costs, such as manufacturers, and those with high leverage may be stocks to avoid.
That was a good coverage, Paul. The thing that I want to mention today, as of right now, today's March 2nd, 2020, some of the information that we're sharing with you in a few days because of the activity in the marketplace is so volatile.
So volatile.
It could change very quickly. So I just want to address what we're giving the viewers is as of this morning, March 2nd, 2020. The last thing I wanted to mention, my old boss that I used to work for, Jack Welch, former CEO of GE, had passed away, and he's going to be thoroughly missed. He was a super guy. He was a super boss. Knew his stuff, and we are going to miss him in the industry of managing. And he had a school going, and I understand he was pretty active in the last few years. So I just wanted to mention that. Anything else that you want to close with, Paul?
Just in times like this, it would have been nice to hear Jack Welch's opinion on what's going on and how he views the markets on this, but he is forever gone, and we will not have that information from him any longer, so he will be missed. And I just want to conclude with, we talked today in generalities about past virus outbreaks, past market downturns. We are by no means implicating things are going to be exactly the same this time, so please proceed with caution. Consult your financial advisor before you take any action regarding your portfolio, whether that's a buy or a sell. Each individual's situation is different and should require personal, detailed review before taking any action.
Well said, Paul. Okay, for Paul Munichel with Ameriprise Financial, myself, Ron Jankowski with Channel 4 and Palos Heights, we wish you a good investment day.